There is a small, almost laughably simple object that sits in the office of the most successful investor in human history. It isn't a supercomputer running complex algorithms. It isn't a crystal ball or a direct line to the Federal Reserve. It's a pile of paper. A stack of reports, prospectuses, and ideas that have been unceremoniously dumped into a basket labeled the, quote, too hard pile. This simple pile, this physical manifestation of humility, is arguably more responsible for the multi-billion-dollar fortune of Warren Buffett than any single brilliant investment he has ever made. Because it represents the most profitable and yet most difficult two words in the entire lexicon of finance: I don't know. In a world that relentlessly demands opinions, that rewards loud conviction and punishes silence, the quiet, disciplined admission of ignorance is a superpower. The vast majority of market participants, from the retail investor glued to their phone to the high-flying fund manager on financial television, feel a crushing pressure to have a take on everything. What's the future of cryptocurrency? Is this biotech startup the next big thing? Will this new technology disrupt an entire industry? They swing at every pitch thrown their way, fouling off most, striking out often, and occasionally hitting a weak single. They believe that activity equals progress, that having an opinion is a prerequisite for participation. Buffett, and the handful of truly intelligent investors who follow his philosophy, understand a deeper truth. Your financial success is not determined by the number of things you are right about. It is determined by the magnitude of your correctness on the handful of things you can truly understand. The too hard pile is the ultimate filter. It is the guard at the gate of your capital, turning away the complex, the unpredictable, and the unknowable. It is the discipline that allows you to stand at the plate, bat on your shoulder, and watch dozens of pitches go by. Mediocre pitches, tricky pitches, pitches that everyone else is swinging at wildly, until that one perfect, slow-moving fastball comes right down the center of your strike zone. Then, and only then, do you swing with everything you have. This is not a lesson about complex stock analysis. It is a lesson in intellectual honesty and profound risk management. It is about building a system that protects you from your own worst instincts, the fear of missing out, the allure of a good story, the ego-driven need to appear omniscient. By embracing the power of I don't know, you preserve your capital from the thousand small cuts of uninformed bets and speculative gambles. You free your mind from the noise of the market and focus your energy on the few areas where you have a genuine, unassailable edge. This is the financial transformation we are about to explore. It is the journey from being a market commentator to a true capital allocator, from a gambler to an owner. It is the final promise of a simpler, calmer, and infinitely more profitable way to build wealth. Our journey into this profound mindset begins not with a stock, but with a cultural phenomenon. It begins in the late 1990s, a period of euphoric, unbridled optimism that history now remembers as the dot-com bubble. To understand the power of the too hard pile, you must first immerse yourself in the psychological madness of that era. The narrative was intoxicatingly simple. The internet was changing everything. Old business models were dead. Profitability didn't matter. Eyeballs, clicks, and first-mover advantage were the new metrics of value. Companies with no revenue, no profits, and often no coherent business plan were going public and seeing their valuations explode overnight. A company like Pets.com, which sold pet supplies online, became a market darling, its sock puppet mascot appearing in Super Bowl commercials, even as it was hemorrhaging cash, selling products for less than it cost to acquire them. The market was a frenzy of easy money, and at the center of it all, a lone figure stood aside, looking confused and, according to the financial media of the day, utterly washed up. That figure was Warren Buffett. For years, Buffett's investment vehicle, Berkshire Hathaway, had been a juggernaut, delivering staggering returns by investing in simple, understandable businesses, insurance companies, soft drink manufacturers like Coca-Cola, candy makers like See's Candies, newspapers like the Washington Post. But now, in the face of the new economy, his methods seemed quaint, archaic, and hopelessly out of touch. As tech stocks like Cisco Systems, Microsoft, and Intel soared to astronomical valuations, Berkshire's stock began to lag. From mid-1998 to early 2000, while the tech-heavy Nasdaq Composite Index more than doubled, Berkshire Hathaway's stock price was cut nearly in half. The criticism was relentless and brutal. Barron's published a cover story in December 1999 titled, "What's Wrong, Warren?" The article questioned if Buffett, then approaching 70, had lost his touch. It suggested his refusal to invest in technology stocks was a fatal error, a sign that he was a relic of a bygone era. Pundits and newly minted tech millionaires openly mocked him. He was a dinosaur, they said, who simply didn't get it. The pressure on him was immense. Imagine the sheer psychological fortitude required. Every day, you watch your net worth decline, while others, who are taking risks you fundamentally do not understand, are celebrated as geniuses. Your shareholders are writing you angry letters. The most respected financial publications are questioning your competence. The entire world seems to be screaming that you are wrong. The temptation to capitulate, to just dip a toe into the tech waters to appease the critics and stop the bleeding, must have been overwhelming. But Buffett did not budge. Why? Because every single one of those high-flying tech stocks, from the legitimate giants to the fly-by-night startups, went into his too hard pile. In his 1999 letter to shareholders, written at the very peak of the mania, he laid out his reasoning with startling clarity. He admitted, "I have no special insights about technology." He explained that he and his partner, Charlie Munger, would not pretend to be experts where they were not. They couldn't, with any degree of certainty, predict which of the hundreds of competing tech companies would be the winners in 5, 10, or 20 years. They couldn't confidently project their cash flows. They couldn't determine a sensible price to pay for them. The entire sector for them was unknowable. And so, they did nothing. They sat on their hands, patiently holding onto their portfolio of old economy businesses and a growing pile of cash. This wasn't a prediction that the bubble would burst. It was a simple, humble admission. This is a game we don't understand, so we will not play. This is the foundational anecdote of the too hard pile. It is the story of defining and rigorously defending your circle of competence. Buffett knew the economics of Coca-Cola's brand, the pricing power of Gillette's razors, the float generation of Geico's insurance policies. He could value those businesses with a high degree of confidence. He could not do the same for a company laying fiber optic cable or a business-to-business internet portal. So he didn't. When the bubble inevitably burst in March of 2000, the result was a financial cataclysm. The Nasdaq fell nearly 80% from its peak. Companies like Pets.com went from market darlings to bankruptcy in a matter of months. Trillions of dollars of speculative wealth evaporated. And as the carnage unfolded, Berkshire Hathaway's stock began its steady, powerful ascent once more. The dinosaur had outlasted the meteors. Buffett's discipline, his willingness to endure ridicule and underperformance, was vindicated in the most spectacular fashion imaginable. He preserved his capital not by being smarter about technology, but by being honest about his ignorance of it. His too hard pile was not a sign of weakness, it was his fortress. The genius of Buffett's too hard pile is not rooted in financial acumen, but in a deep, intuitive understanding of human psychology. He has constructed a behavioral defense system against one of the most pervasive and dangerous cognitive biases, the Dunning-Kruger effect. Coined in 1999 by psychologists David Dunning and Justin Kruger, this effect describes a cognitive bias whereby people with low ability at a task overestimate their ability. In essence, the less you know about a subject, the less equipped you are to recognize your own incompetence. This is the intellectual quicksand that swallows the average retail investor. They read a few articles about artificial intelligence, watch a couple of YouTube videos about gene editing, and suddenly feel qualified to pick the winning stock in a fiendishly complex and competitive industry. Their little bit of knowledge gives them an illusion of expertise, a dangerous overconfidence that leads them to make bets far outside their actual circle of competence. Think about the mental state of an investor in 1999. The narrative was simple and powerful. The internet changes everything. This statement is so broad and appealing that it feels like a deep insight. Armed with this insight, the investor starts to believe they understand the landscape. They see companies with .com in their name, and through a process of confirmation bias, seek out information that reinforces their initial belief. They read the bullish analyst reports, they listen to the optimistic pundits, and they ignore the fine print in the S1 filings that shows a company is burning through cash with no path to profitability. They mistake familiarity with a trend for a deep understanding of a specific business. Buffett's too hard pile is a systematic break on this process. It forces a moment of brutal self-assessment. The question it asks is not, do I think the internet is a big deal, but rather, can I, with a high degree of certainty, project the cash flows of this specific e-commerce company over the next 10 years, and can I determine a price for that stream of cash that provides a margin of safety? For 99.9% of the companies in the tech sector at that time, his answer was no. The Dunning-Kruger effect was telling everyone else they were a genius for buying tech stocks. Buffett's humility was telling him he was an idiot if he tried. This is a profound act of intellectual discipline. The human brain is wired to create narratives, to connect dots, to feel a sense of mastery. Admitting, "I don't know," is uncomfortable. It feels like a failure. The market amplifies this feeling, presenting itself as a continuous test of intelligence. Every stock that goes up that you don't own feels like a personal failing, a missed opportunity that proves your inadequacy. The too hard pile is a declaration of independence from this destructive mindset. It is the understanding that in investing, you don't get extra points for difficulty. You don't get a higher return for solving a complex calculus problem versus a simple arithmetic one. The goal is not to prove you're the smartest person in the room. The goal is to make money. And the easiest way to make money is to avoid losing it, which you do by staying away from games where you are at a clear disadvantage. By defining a circle of competence, you are not limiting your opportunities, you are concentrating your efforts. You are focusing your finite time and intellectual energy on the areas where you can develop a genuine informational or analytical edge. You are deliberately choosing to compete on your home turf, where you know the rules, the players, and the terrain. Everyone else, driven by the illusion of knowledge, is running off to fight battles on unfamiliar ground, where they are almost certain to become casualties. So how can a regular person, an entrepreneur, a retail investor, translate this powerful principle into a practical, repeatable process? This isn't some esoteric wisdom available only to billionaires in Omaha. It is a blueprint, a mental model that anyone can apply to achieve financial freedom and improve their executive decision-making. The first step is to build your own circle of competence. This requires a pen and paper and an honest self-inventory. Step 1. Divide the paper into 3 columns. In the first column, list your professional expertise. What industry have you worked in for years? Do you understand the logistics of supply chains, the economics of a software-as-a-service business, the nuances of medical billing? This is your most fertile ground. You speak the language, you know the key metrics, you understand the competitive landscape in a way that a Wall Street analyst looking at a spreadsheet never will. Step 2. In the second column, list your deep, passionate hobbies. Are you a car fanatic who can break down the brand equity of Ford versus Ferrari? A gamer who understands the ecosystem of game developers and platform holders? A home cook who knows the difference in quality and brand loyalty between different consumer packaged goods? These are areas where you have put in the 10,000 hours of learning for fun. Step 3. In the third column, list subjects you are genuinely intellectually curious about and willing to study intensely for a prolonged period. Not just read a few articles, but read textbooks, industry journals, and the last decade of annual reports for the major players. Once you have this list, everything else, literally every other industry and company in the world, starts in the too hard pile. That is your default setting. The assumption is ignorance. An idea is only allowed out of the too hard pile after it passes a rigorous test. This brings us to the blueprint's second phase, the Feynman test, named after the brilliant physicist Richard Feynman, who famously said, "If you can't explain it to a 6-year-old, you don't understand it yourself. Before you even consider investing in a company, you must be able to describe, in simple, clear language, exactly how it makes money and why it will continue to make money for a very long time. What is its product or service? Who are its customers? What gives it a durable competitive advantage, a moat that protects it from competitors? If your explanation involves jargon, buzzwords, or convoluted technological processes, it fails the test. Back into the too hard pile it goes. A company like Hershey's passes this test with flying colors. People love chocolate, they trust the brand, and they will likely continue to buy it for decades. A pre-revenue biotechnology company developing a novel therapy using CRISPR gene editing technology? For 99.9% of us, that belongs deep, deep in the too hard pile. This simple test acts as a powerful filter, screening out the complex and the speculative, and forcing you to focus on businesses with understandable, resilient economics. This is the core of intelligent investor methodology and a cornerstone of long-term portfolio growth. The path of the 99%, the antithesis of this disciplined approach, is a chaotic and costly scramble. The average investor operates with no defined circle of competence. Their portfolio is a random collection of story stocks and hot tips. They hear about a company on the news or from a friend at a barbecue, and, driven by FOMO, they buy it without doing an ounce of real research. They treat the stock market not as a venue for partial ownership of real businesses, but as a casino. Let's paint a picture of this investor. Let's call him Greg. Greg works in accounting for a construction company. He is competent in his field, but his investment strategy is a disaster. One month, he's buying shares in a Canadian cannabis company because he read an article about legalization. He doesn't understand the regulatory environment, the pricing pressures from the black market, or the capital-intensive nature of cultivation. The stock plummets, and he sells in a panic. Next, his tech-savvy nephew tells him a certain cryptocurrency is the future of finance. Greg buys in at the peak, not understanding the technology, the use case, or the speculative nature of the asset. The crypto market crashes, and he loses a huge chunk of his capital. Then, he sees a charismatic CEO on TV talking about disrupting the electric vehicle market. He buys the stock, captivated by the story, without ever looking at the company's balance sheet, which shows billions in debt and a staggering cash burn rate. Greg's mistake is fundamental. He feels he has to have a play in every hot sector. He believes that to win, he has to be where the action is. He is constantly venturing onto battlefields where he is hopelessly outgunned. He doesn't know how to read a financial statement, he doesn't understand competitive strategy, and he has no framework for valuation. His decisions are driven by emotion, narrative, and social proof. The result is a portfolio churned by transaction costs, ravaged by ill-timed emotional decisions, and ultimately doomed to massive underperformance. He is ignoring Buffett's two cardinal rules of investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. The too hard pile is the most effective tool ever devised for adhering to these rules. Greg's failure is a failure of humility. He never stops to say, "I don't know," and his capital pays the price for his arrogance. His quest for financial freedom becomes a treadmill of losses because he refuses to acknowledge the limits of his own knowledge. The direct financial connection between maintaining a circle of competence and superior investment returns is not theoretical, it is mathematically concrete. When you operate within your circle, your ability to perform an accurate valuation of a business increases exponentially. Valuation is the process of determining the intrinsic worth of an asset. For a business, this typically involves projecting its future free cash flow and then discounting it back to the present day. The inputs for this model are not just numbers on a spreadsheet, they are qualitative judgments about the future. How fast will revenues grow? What will profit margins look like? How much capital will the business need to reinvest to maintain its position? An investor who deeply understands an industry has a massive advantage in answering these questions. A person who has worked in retail for 20 years has an intuitive feel for a retailer's brand strength, its relationship with suppliers, and the threat of e-commerce. Their projections for a company like Walmart or Costco will be far more accurate and have a much smaller range of error than their projections for a semiconductor company like Nvidia. This confidence in your valuation allows you to act decisively when the market offers you a great price. When you know a business is worth $100 per share, and the market, in a fit of panic, offers it to you for $50, you can buy it with conviction. This is the concept of margin of safety, the bedrock of value investing. You are not hoping the stock goes up. You are buying an asset for far less than it is demonstrably worth. Conversely, when you are outside your circle of competence, you have no anchor for valuation. You cannot distinguish between price and value. You are simply guessing. This is why speculative bubbles form. People buy assets not because they are cheap relative to their intrinsic worth, but because they believe the price will be higher tomorrow. They are playing a game of crater fool, and this inevitably ends in a catastrophic loss of capital. By sticking to what you know, you avoid these games entirely. You transform investing from a speculative act into a commercial one. You are not buying a ticker symbol. You are buying a piece of a business whose economics you understand. This discipline manifests directly on your personal balance sheet. It leads to lower portfolio turnover, which reduces taxes and transaction costs. It dramatically lowers the risk of permanent capital loss, the kind of loss from which it is almost impossible to recover. And most importantly, it allows you to make large, concentrated bets when a true opportunity arises, which is the only way to generate the kind of portfolio growth that leads to real, lasting wealth and financial independence. The too-hard pile is the simple mechanism that makes all of this possible. The second great pillar of this philosophy is the brutal, often painful discipline of inaction. In our hyper-caffeinated, productivity-obsessed culture, the idea of doing nothing is seen as a form of failure. We are conditioned to believe that effort is directly proportional to results. The harder you work, the more you trade, the more you research, the better your outcomes will be. The financial industry is built on this premise, encouraging constant activity, new products, and rapid-fire decisions. Warren Buffett's approach is a radical and powerful counter-narrative. He understands that in investing, activity is often the enemy of returns. The too-hard pile is not just a filter, it's a cage for your worst impulses. It is the physical embodiment of strategic patience, the commitment to wait for the perfect opportunity rather than constantly chasing mediocre ones. The greatest illustration of this principle in Buffett's career unfolded over a long, frustrating period in the mid-2000s, a time when his discipline of inaction was tested to its absolute limit, only to result in one of the greatest investment coups in financial history. From 2005 to 2007, the global economy was roaring. The stock market was climbing to new highs, fueled by a housing boom and a wave of cheap credit. Private equity firms were executing massive leveraged buyouts, and investment banks were minting money through complex financial instruments like collateralized debt obligations or CDOs. It was another party, and just like in 1999, Warren Buffett was the one standing in the corner, refusing to dance. Berkshire Hathaway began to build up an enormous and ever-growing pile of cash on its balance sheet. By the end of 2007, it stood at over $45 billion. Once again, the critics came out in force. They accused Buffett of being too conservative, of being unable to find attractive investments in the modern market. Cash is trash, the saying goes, and Buffett was holding a mountain of it, earning a paltry return while the S&P 500 was surging. They argued his inaction was a massive opportunity cost, a drag on Berkshire's performance. What the critics failed to understand was that Buffett's inaction was not passive. It was an active, strategic choice. As he looked at the investment landscape, he saw rampant speculation. He saw asset prices inflated by excessive debt. He saw banks taking on risks they didn't understand. In his 2005 shareholder letter, he wrote about the dangers of derivatives, calling them financial weapons of mass destruction. He put the entire ecosystem of complex, debt-fueled finance into his too-hard pile. He couldn't predict when the party would end, but he knew the fundamentals were unsound. He simply could not find businesses or securities that met his strict criteria: an understandable business, with favorable long-term economics, run by able and trustworthy management, available at a sensible price. With prices for both stocks and entire companies being bid up to dizzying heights, the last criterion, a sensible price, was almost impossible to meet. So he waited. He did nothing. He let the cash pile up, enduring the criticism and the relative underperformance, confident that patience was the ultimate strategic asset. Then, in September of 2008, the world broke. The collapse of Lehman Brothers triggered a global financial crisis, a panic of a magnitude not seen since the Great Depression. Credit markets froze. The stock market went into free fall. The very institutions that had been celebrated as masters of the universe were now facing insolvency. Fear was everywhere. And in the midst of this terror and chaos, Warren Buffett, with his mountain of cash, transformed from a slow-moving tortoise into a swift and decisive eagle. The phone in his Omaha office began to ring. On one end were the desperate CEOs of the world's most powerful financial institutions. On the other was the man they had mocked, the one person who had the capital and the credibility to save them. In the span of a few weeks, he executed a series of legendary deals. He invested $5 billion into Goldman Sachs and $3 billion into General Electric, not by buying their common stock, but by purchasing preferred shares that paid him a fat 10% dividend, and he also received warrants to buy their common stock at rock-bottom prices for years to come. A year later, he would provide a similar lifeline to Bank of America. He was not a seller in the panic. He was the buyer of last resort. He was providing the liquidity and stability the system desperately needed, and he was being compensated for it on terms that were almost unimaginably favorable. His discipline of inaction during the boom years had given him the ultimate weapon during the bust: a fortress-like balance sheet and cash ready to deploy. He had preserved his capital and, just as importantly, his psychological equilibrium. While everyone else was panicking, he was calmly and rationally making the investments of a lifetime. The too-hard pile, which for years had been filled with overpriced stocks and complex derivatives, had done its job. It had kept him out of the bubble, preserving his resources for the moment the bubble burst. This is the profound power of inaction. It is the source of optionality. Cash is not trash. Cash is a call option on future bargains, an option that becomes priceless when bargains are everywhere and cash is nowhere to be found. The human brain is fundamentally not wired for this kind of patience. We are victims of what behavioral scientists call the action bias. In situations of ambiguity, our instinct is to do something, anything, rather than nothing. This is an evolutionary holdover. If you're a hunter-gatherer and you hear a rustle in the bushes, it's better to run or throw a spear than to stand still, even if it's just the wind. The cost of inaction, getting eaten, is perceived as higher than the cost of a needless action, wasting energy. In the modern world of investing, this instinct is a catastrophic liability. The market is a constant stream of rustles in the bushes, a bad earnings report, a geopolitical event, a new trend. The action bias screams at us to react, to sell, to buy, to rebalance. This is compounded by an even more powerful psychological force: fear of missing out, or FOMO. FOMO is the engine of nearly every speculative bubble. It's a primal, social anxiety that others are experiencing rewarding opportunities from which we are absent. When your friends are telling you how much money they're making on a particular stock, when the news is filled with stories of overnight millionaires, the feeling of being left behind is intensely painful. It triggers our competitive instincts and our desire for social status. This emotional cocktail overrides rational analysis. We stop asking, "Is this a good investment?" and start asking, "How can I get in on this?" The desire not to miss the party becomes more powerful than the fear of losing money. The too-hard pile is a direct, systemic antidote to both action bias and FOMO. It creates a deliberate, unemotional process that must be completed before any action can be taken. It forces you to slow down. It replaces the emotional question, should I buy this, with a series of rational, analytical questions. Do I understand this business? Can I value it? Is it cheap? In most cases, especially with the hot stock of the moment, the answer will be no. And the instruction is clear. Do nothing. Put it in the pile and move on. This is a form of pre-commitment. You are making a decision in a calm, rational state, creating the rules for your too hard pile that binds your hands in a future emotional state when you're tempted by FOMO. It's like Ulysses tying himself to the mast to resist the sirens song. You know your future self will be tempted to do something foolish, so you create a system in the present to prevent it. Adopting this mindset is liberating. It frees you from the need to have a moment-to-moment opinion on the market. It allows you to ignore the daily noise and focus on the long-term signal. It transforms investing from a stressful, reactive activity into a calm, proactive one. You are no longer a leaf blown about by the winds of market sentiment. You are a stone, patiently waiting, unmoved by the chaos around you, until the precise moment to act becomes clear. This shift from frantic activity to disciplined inaction is a crucial step towards mastering the CEO mindset, where strategic patience is valued far more than busy work. To operationalize the discipline of inaction, you need more than just willpower. You need a system. The most effective tool for this is the creation of a formal investment checklist, or a set of kill criteria. This is a non-negotiable list of requirements that a potential investment must meet before you even consider deploying capital. This model, used by many professional investors, including Mohnish Pabrai, who was heavily influenced by Buffett and Munger, serves as your personal gatekeeper. Step 1 is to craft your checklist. It should be based on the core tenets of value investing. For example, your checklist might include: 1. Is the business within my circle of competence? 2. Does the business have a durable competitive moat? 3. Does the business have a long history of consistent and growing earnings and free cash flow? 4. Is the management team honest and competent with a track record of intelligent capital allocation? 5. Is the balance sheet strong with manageable debt? And 6. Is the stock trading at a significant discount to my conservative estimate of its intrinsic value? Step 2 is the ruthless application of this checklist. When you come across a new idea, you subject it to this interrogation. The key is that a failure on any single point results in immediate disqualification. The idea goes straight into the too hard pile. There are no exceptions. The business might be wonderful, but if the price isn't right, it goes in the pile. The stock might be cheap, but if the business is mediocre with no moat, it goes in the pile. The management might be brilliant, but if the balance sheet is loaded with debt, it goes in the pile. This removes emotion and subjectivity from the initial screening process. It prevents you from falling in love with a story and overlooking fatal flaws. Step 3 is to manage your information flow and decision-making environment to support inaction. This means checking your portfolio less frequently. Daily or even hourly monitoring encourages tinkering and overtrading. Schedule portfolio reviews for once a quarter. Unsubscribe from market news services that promote sensationalism and short-term thinking. Replace that noise with primary source documents, annual reports, investor presentations, and industry publications. By controlling your environment, you reduce the number of stimuli that trigger your action bias, making it easier to stick to your discipline. This structured approach to inaction is a cornerstone of effective wealth management and a direct path to superior long-term results. The antithesis to this patient, checklist-driven approach is the path of the 99%, the hyperactive trader. This individual is addicted to the thrill of action. Their screen is a kaleidoscope of flashing red and green numbers. They are subscribed to a dozen trading services, they're active in stock market forums, and they treat the market opening like the start of a sporting event. Let's call this person Tina. Tina believes that she can outsmart the market through sheer speed and volume of trades. She's a swing trader one week, a momentum trader the next. She buys a stock because it's breaking out to a new high, only to sell it a few days later when it pulls back. She hears a rumor about a potential buyout and jumps in, hoping for a quick pop. Her portfolio has no coherent theme or strategy. It's a revolving door of ticker symbols. Tina is a victim of what Nassim Taleb calls the noise bottleneck. She is consuming vast quantities of low-quality information, market chatter, news headlines, price charts, and mistaking it for valuable signal. Every piece of noise prompts a decision, an action. The result is a portfolio that is constantly being churned. Each trade incurs a transaction cost. If she holds a stock for less than a year, any capital gains are taxed at a much higher short-term rate. But the biggest cost is subtler: volatility drag, or variance drain. By constantly trading in and out of volatile stocks, she is ensuring she buys high and sells low with demoralizing frequency. She might have a few exciting wins, which provide the dopamine hit that keeps her addicted to the game, but over the long run, the small, consistent losses and the costs of friction grind her portfolio down. She is running on a treadmill, putting in a tremendous amount of effort, time, and emotional energy, only to end up far behind someone who simply bought a low-cost index fund and did nothing. Tina's fundamental error is her belief that she is being paid for activity. The market, in reality, pays for correct, long-term judgment. By refusing to be inactive, she denies herself the time and mental space required for that judgment to develop. The financial impact of strategic inaction versus hyperactivity is stark and quantifiable. First, let's consider the direct costs. An active trader might have a portfolio turnover of 200% per year, meaning they replace their entire portfolio twice. Assuming transaction costs of just 0.5% per trade, buy and sell, that's a 2% annual drag on returns right off the top. Add in the higher taxes on short-term gains, and the hurdle to simply break even with a passive strategy becomes enormous. But the real power lies in the concept of optionality. Holding cash, as Buffett did before the 2008 crisis, is not a zero-return proposition. It is the purchase of an option. It's an option to buy assets at distressed prices at some unknown point in the future. The value of this option, known as optionality, is impossible to calculate precisely, but it is immense. When markets are calm and prices are high, the value of this option is low. When markets panic and prices collapse, the value of this option explodes. Think of it this way. The investor who was fully invested in an S&P 500 index fund in October 2007 saw their portfolio get cut in half by March 2009. They then had to wait over 4 years until 2013 just to get back to where they started. Buffett, by holding cash, not only avoided the majority of that devastating loss, but was able to deploy that cash at the bottom, buying world-class assets like Goldman Sachs at prices that provided immediate 10% dividend yields plus massive upside potential. His returns during the recovery were therefore amplified. He was playing offense while everyone else was simply trying to survive. The discipline of inaction, of allowing cash to build when no great opportunities are present, is what creates this profound asymmetry. It limits your downside during a crash and magnifies your upside during the recovery. It is the ultimate tool of long-term risk management, ensuring that you not only survive the inevitable storms, but are positioned to sail faster and farther once they have passed. This is how you move from merely participating in the market to truly beating the market over the long term. The third pillar supporting this entire framework is a liberating act of psychological rebellion, escaping the tyranny of opinion. We live in an information-saturated world that constantly demands our judgment. From politics to pop culture to financial markets, we are pressured to have a viewpoint, to pick a side, to make a call. On social media and financial news networks, confident-sounding opinions are the currency of the realm. Pundits are paid not for being right, but for being loud and certain. This cultural pressure seeps into our investment psyche, creating a debilitating belief that we must have an opinion on every major company, every economic trend, and every market gyration. The too hard pile is a radical declaration of dissent. It is the courage to say, I don't have an opinion on that, because I haven't done the work. It's the wisdom to recognize that a weakly held, uninformed opinion is not just useless, but actively dangerous to your financial health. A perfect story to illustrate this principle comes not from Buffett himself, but from his indispensable partner, Charlie Munger, a man whose intellectual honesty is legendary and whose aversion to feigned expertise is absolute. In the years before Berkshire Hathaway became the behemoth it is today, Munger was running his own successful investment partnership. He and his partners were approached with a proposition to invest in a highly complex business involving financial arbitrage and derivatives. The promoters of the deal were brilliant, with impeccable credentials and a sophisticated mathematical model that seemed to prove the strategy was a surefire winner. The projected returns were astronomical. Munger and his team spent a great deal of time studying the proposal. They were smart men, well-versed in business and finance. But as they dug deeper, they found they couldn't quite grasp all the moving parts. The math was elegant, but it rested on a series of assumptions about market behavior and correlations that seemed fragile. They couldn't fully model the second and third order consequences, the knock-on effects, if one of their core assumptions proved wrong. There was a level of complexity and opacity that made them deeply uncomfortable. This was a classic temptation. The story was compelling, the people were smart, and the promised rewards were enormous. The easier path would have been to defer to the experts, to trust the complex model, and to invest. To admit that they, Charlie Munger's partnership, couldn't understand it would have been an admission of intellectual limitation, but Munger's response was simple and decisive. He passed on the investment. He told his partners, in essence, I don't know. He couldn't be certain what all the risks were, and if he couldn't understand the risks, he wasn't going to play. This idea went straight into his too hard pile. This anecdote is crucial because it goes beyond simply avoiding industries you know nothing about, like technology for Buffett. This was Munger's own field, finance and investment, and he still had the discipline to admit when a specific opportunity within that field was too convoluted and unpredictable to be a safe bet. His decision was prescient. The history of finance is littered with the corpses of firms that blew up because they were engaged in strategies that were too complex for even their own managers to fully understand. The most famous example is long-term capital management, LTCM, a hedge fund run by Nobel Prize-winning economists that collapsed in 1998, nearly taking the global financial system with it, because their complex arbitrage models failed to account for extreme, real-world events. Munger's humility protected his capital from a similar fate. He knew that in investing, it's the risks you don't see that get you, and the more complex the investment, the more unseen risks there are likely to be. The psychological forces that push us to form these dangerous, uninformed opinions are powerful and deeply ingrained. The first is the availability heuristic. This is our mental shortcut of judging the likelihood of an event by how easily examples of it come to mind. The companies and stocks that are most available to us are the ones constantly discussed in the news: Tesla, Apple, Nvidia, or whatever the hot IPO of the month is. Because we hear about them constantly, our brains are tricked into thinking we know a lot about them. We mistake this media-driven familiarity for genuine knowledge. We feel we should have an opinion on Tesla's production numbers or Apple's next product cycle because the information is so ubiquitous. We feel an intellectual pressure to participate in the conversation. This is magnified by the principle of social proof. When everyone around us is talking about a particular stock and seems to have a strong conviction, we feel an intense pressure to conform. If everyone at the office is buying a certain cryptocurrency, it feels risky and isolating to be the only one who isn't. Our brains interpret this social consensus as a signal of correctness. If so many other people believe this, there must be something to it, we reason. This is the psychological engine of market manias. It's not based on a collective, independent analysis of the facts. It's a social contagion of belief. The too hard pile is a powerful shield against both of these biases. It establishes a personal, internal standard of due diligence that must be met before an opinion can be formed. It doesn't matter if a company is on the news every night or if all your friends are buying it. The question remains: have done the work to understand this business on a fundamental level? By making this the sole criterion for engagement, you insulate yourself from the noise of public opinion and the pressure of the herd. You trade the fleeting comfort of fitting in for the long-term security of thinking for yourself. This is the essence of the intelligent investor, a mindset that prioritizes independent analysis over social consensus and is a critical component of any successful financial education. How do you implement this escape from the tyranny of opinion in your own life? The blueprint is to consciously curate an information diet. Just as you manage your physical health by choosing what food you consume, you must manage your financial health by choosing what information you consume. Step 1 is a radical act of subtraction. Go on a news fast. Unfollow the market gurus on social media. Delete the stock market apps from your phone that send you constant price alerts. Cancel your subscription to cable financial news. This fire hose of information is not designed to make you a better investor. It is designed to trigger your emotions, provoke a reaction, and sell advertising. 99% of it is noise, not signal. Step 2 is to replace this low-quality information with high-quality primary sources. Your goal is to get as close to the source as possible. The single best source of information about a public company is its own annual report, the 10K filing. This is a legally mandated document, audited by accountants, where the company must disclose its strategy, its results, its competitive landscape, and the risks it faces. It is dense, it is often boring, and it is the closest thing to ground truth you can find. Your new rule should be: I will not allow myself to have an opinion on a company until I have read, at a minimum, its last 3 annual reports and the shareholder letters from its CEO. This single rule, if followed rigorously, will be transformative. It will immediately disqualify 95% of the stocks that vie for your attention. It forces a shift from passive consumption of opinions to active, effortful analysis. Step 3 is to supplement this with high-quality, industry-specific information. If you're interested in the railroad industry, for example, read trade journals like Railway Age. This will give you a much deeper understanding of the sector's economics and challenges than you will ever get from a TV pundit. By deliberately changing your information inputs, you will fundamentally change your decision-making outputs. You will move from being a reactor to market noise to being a thoughtful analyst of business reality. The path of the 99% is the polar opposite. The average investor, let's call her Jennifer, is an information junkie. She wakes up and immediately checks the pre-market futures. She has financial news on in the background while she works. She has price alerts set for a dozen different stocks. Jennifer is a classic CNBC-driven investor. She hears a guest on the show make a compelling bull case for a software company. The story is exciting: artificial intelligence, cloud computing, massive growth potential. Within minutes, she's on her brokerage app buying a few shares. She hasn't read the annual report. She doesn't know who the company's competitors are. She couldn't name the CEO. She has no idea what its valuation is relative to its earnings or cash flow. She has outsourced her thinking to a television personality. A few weeks later, a different pundit on another show presents a bearish case. He talks about rising interest rates and competitive threats. Panic sets in. Jennifer's shallowly held conviction evaporates instantly. She sells the stock, likely for a small loss. She has been whipsawed by the relentless, contradictory tide of market opinion. Jennifer feels informed because she is constantly consuming information, but she is confusing quantity with quality. She has an opinion on everything: the Federal Reserve's next move, the direction of oil prices, the future of retail. But these opinions are not her own. They are borrowed, rented from the media, and they have no solid foundation of research to support them. As a result, she has no conviction. When the market goes against her, she has no analytical anchor to hold on to, so she is tossed about by the waves of fear and greed. This is a stressful and ultimately losing game. It's an endless cycle of chasing trends, reacting to headlines, and paying the high price for having an opinion without having done the work. It is the very definition of a retail investor trap, and it guarantees a failure to achieve long-term financial independence. The direct financial connection here is profound, and it centers on the power of conviction-weighted asset allocation. True wealth in the stock market is not built by having 100 mediocre ideas. It is built by having a handful of truly brilliant ones and having the courage to bet heavily on them. The process of rigorously filtering ideas through your too hard pile and your information diet is designed to produce exactly this: a small number of opportunities where you have developed a deep, almost unshakable conviction based on your own independent work. Because you have done the research, you understand the business better than 99% of other market participants. You have a firm grasp of its value. This high level of conviction allows you to allocate your capital more effectively. Instead of spreading your money thinly across 50 different stocks you barely know, a strategy often called diversification, you can make a meaningful investment, say 10 to 15% of your portfolio, in a single outstanding business that you understand inside and out. When one of these high-conviction ideas works out, it has a material impact on your overall portfolio growth. A 30% gain on a 15% position increases your total net worth by 4.5%. A 30% gain on a 1% position is a rounding error. It is concentration, not diversification, that builds fortunes. But you must not, concentrate your capital unless you have extreme conviction. And you cannot have that conviction if you are forming casual opinions on dozens of companies. The discipline of saying "I don't know" to almost everything is the prerequisite for being able to say "I know" with the force and certainty required to make a truly meaningful investment. It clears the decks, focusing your limited capital and attention on the A-plus opportunities. This is how the too hard pile, paradoxically, leads to a more aggressive and more profitable investment strategy. It ensures that when you finally do swing, it is with the full force of your capital and conviction, at the perfect pitch you have been patiently waiting for. This is the professional approach to asset allocation, a world away from the scattered, opinion-driven gambling of the average market participant. This leads us directly to the fourth and perhaps most crucial pillar of this philosophy: the unwavering commitment to capital preservation as the prime directive. Before you can even think about growing your money, you must be obsessed with not losing it. This sounds obvious, but in practice, most investors are wired to chase upside, often ignoring or downplaying the potential for downside. They are gamblers looking for a winning lottery ticket. The intelligent investor, the true business owner, is fundamentally a risk manager. They know that the math of compounding is unforgiving. A 50% loss requires a 100% gain just to get back to even. A single catastrophic loss can wipe out years of hard-won gains. The too hard pile is, at its core, a risk management tool. Its primary function is not to find winners, but to ruthlessly eliminate the potential losers. It is the embodiment of Buffett's rule number 1: never lose money. A formative investment from Buffett's early career provides the perfect illustration of this defensive mindset in action: his 1973 investment in the Washington Post. The market environment in the early 1970s was dismal. The Nifty 50 growth stock bubble had just burst, the country was mired in the Watergate scandal, and inflation was beginning to spiral out of control. It was a period of deep pessimism, and no industry felt it more acutely than the newspaper business. Investors were terrified that the rise of television news would make newspapers obsolete. As a result, newspaper stocks were trading at absurdly low valuations. The Washington Post company was no exception. At its low point, the entire market capitalization of the company, the total value of all its shares, sank to just $80 million. Many investors saw a dying business in a doomed industry and threw it in their, quote, avoid at all costs pile. But Buffett saw something entirely different. He put on his business analyst hat, not his stock market speculator hat. He knew the newspaper business. It was squarely within his circle of competence. So he started to dig into the company's assets, piece by piece. He saw, first of all, that the Washington Post newspaper itself was not just any paper. It was a dominant, world-class media institution with immense pricing power and a near monopoly in its market. He estimated that the newspaper alone was worth far more than the entire company's stock price. But that was just the beginning. He then looked at the other assets the company owned, assets the market was completely ignoring. The company owned Newsweek magazine. It owned several profitable network-affiliated television stations in major markets like Miami and Hartford. In an era before cable, these TV stations were pure gold, gushing free cash flow. Buffett did a quick, conservative valuation of these ancillary assets. The TV stations alone, he calculated, were worth at least $100 million, if not more. This was the light bulb moment. You could buy the entire company for $80 million and essentially get the Washington Post newspaper, Newsweek, and other assets for free. The downside was almost non-existent. He wasn't betting on a heroic turnaround. He wasn't making a grand prediction about the future of media. He was simply buying a dollar bill for 40 cents. The collection of high-quality assets provided an enormous margin of safety. The risk of permanently losing capital on this investment was vanishingly small. Other sexier stocks of the day, the 1970s equivalent of tech or biotech, went into his too hard pile. They might have had more explosive upside potential, but they also carried the risk of total loss. The Washington Post was a business he could understand, value, and where the downside was massively protected. He invested over $10 million, a huge sum for him at the time, and it would become one of the most successful investments of his career, multiplying over 100-fold in the decades that followed. The too hard pile cleared his mind of the noise and allowed him to focus his capital on this one, incredibly safe and deeply undervalued opportunity. The psychological principle underpinning this defensive strategy is one of the most powerful forces in human behavior: loss aversion. Pioneering research by psychologists Daniel Kahneman and Amos Tversky showed that humans experience the psychological pain of a loss approximately twice as intensely as the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. This asymmetry has profound implications for investor behavior. It's why people panic sell at the bottom of a market crash. The emotional pain of seeing their portfolio decline becomes unbearable, and they sell simply to make the pain stop, locking in their losses at the worst possible moment. It's also why people hold on to losing stocks for too long, praying they will get back to even, because selling would mean crystallizing the painful loss. Buffett's capital preservation mindset is a conscious system designed to manage the destructive power of loss aversion. He knows that the best way to avoid the psychological trauma that leads to bad decisions is to avoid significant losses in the first place. The too hard pile is his first line of defense. By refusing to invest in businesses he doesn't understand, he is systematically avoiding situations where he cannot accurately assess the probability and magnitude of a potential loss. If you can't understand the competitive threats to a software company or the science behind a new drug, you have no way of knowing what its true downside risk is. You are flying blind. By sticking to businesses with predictable earnings and strong balance sheets, he is ensuring that even if his investment thesis is wrong, the odds of a catastrophic 100% loss are extremely low. This focus on return of capital before return of capital keeps him out of the speculative manias and emotionally charged situations that destroy the average investor. He is not trying to avoid all losses. That's impossible. He is trying to avoid the big, dumb, permanent loss that comes from venturing into the unknown. To build this defensive moat around your own capital, you must adopt a powerful mental model used by elite decision-makers in all fields, the pre-mortem analysis. This concept, popularized by psychologist Gary Klein, is a simple yet profound inversion of the typical planning process. Instead of asking, "How can this succeed?" you ask, "Assuming this has already failed, what went wrong?" Step 1. Before you make any investment, you must imagine that it is 1 year in the future and the investment has been a complete disaster. Your stock is down 80%. Step 2. You must then write a detailed, plausible story explaining exactly why it failed. Be specific. Did a new competitor emerge with a better product? Did a key patent expire? Did the CEO turn out to be a fraud? Did the company's debt burden become unmanageable during a recession? Did a technological shift make their business model obsolete? This exercise is incredibly powerful because it forces you to confront the potential risks head-on, bypassing your natural confirmation bias. You are actively searching for reasons why you might be wrong. Step 3 is the crucial filter. If you can easily write several different, highly plausible stories of catastrophic failure that depend on factors that are complex, unpredictable, or outside of your control, the investment belongs in the too hard pile. For example, for a young biotech company, the pre-mortem might include failure in phase 3 trials, rejection by the FDA, a competitor reaching the market first, or an inability to secure further funding. These are all plausible, hard-to-predict paths to ruin. For a company like Coca-Cola, it is much harder to write a plausible story of its business being down 80% in a year. The brand is too strong, the distribution network too vast, the business model too simple. The pre-mortem analysis is your personal risk management department. It is a systematic way to identify and avoid the investments that carry the hidden fatal flaws that lead to a permanent loss of capital. It's a tool for entrepreneurs, a CEO mindset for your own finances. The antithesis of this disciplined, risk-first approach is the hope-and-a-prayer investor. This is the person who is completely captivated by the story of a company and its potential upside, while giving zero thought to the downside. Let's call him Frank. Frank invests in what are often called concept stocks. These are companies with a revolutionary idea, but often no revenue, no profits, and a business model that is entirely unproven. Frank might invest in a company that promises to mine asteroids, or a startup with a new social media app that hasn't been launched yet. His investment thesis is based entirely on the size of the potential market. If they just get 1% of this trillion-dollar market, he reasons, the stock will go to the moon. Frank is falling in love with the narrative. He is drawn to charismatic CEOs who are great storytellers. He is buying a lottery ticket, not a piece of a business. He never performs a pre-mortem. He never asks the tough questions. What if the technology doesn't work? What if they can't raise more money? What if a large, established competitor decides to enter their market? He ignores the balance sheet, which is often a horror show of debt and cash burn. His entire focus is on the potential reward, and he is completely blind to the very real and very high probability of total loss. When these concept stocks inevitably fail, as the vast majority do, Frank doesn't just lose some of his money. He often loses all of it. This is the path of permanent capital destruction. It is the siren song of getting in on the ground floor of the next big thing. A song that has led countless investors onto the rocks of financial ruin. The disciplined use of a too hard pile is the Ulysses contract that saves you from this fate. The direct financial connection between a capital preservation mindset and long-term wealth creation is undeniable, and it lives on the balance sheet. A company's balance sheet is a snapshot of its financial health. It lists what the company owns, assets, and what it owes, liabilities. The difference is shareholder equity. A company with a fortress-like balance sheet has lots of cash and assets, and very little debt. This is a tangible margin of safety. In a severe recession, this company can survive. It can continue to invest in its business, and it can even buy up weaker competitors who are struggling with their own debt loads. A company with a leveraged balance sheet, loaded with debt, is fragile. A small disruption in its earnings can make it unable to service its debt, leading to bankruptcy and a complete wipeout for shareholders. When you use a too hard pile, you naturally gravitate away from companies with fragile, leveraged balance sheets. Why? Because the future of a highly indebted company is inherently more complex and unpredictable. Its fate depends not just on its own operational performance, but on the mood of its creditors and the state of the credit markets. This adds a layer of unknowable risk that a prudent investor will avoid. By focusing on businesses with strong balance sheets and consistent free cash flow, you are building a portfolio that is resilient, it is anti-fragile, it is designed to withstand economic shocks. This defensive posture is the secret to long-term compounding. Compounding only works if you avoid major setbacks. The never lose money rule is not about avoiding small temporary dips in stock prices. It is about avoiding the catastrophic, portfolio-crippling blow-ups that force you to start all over again. The too-hard pile is your most powerful tool to ensure you stay in the game long enough for the magic of compounding to work in your favor. We now arrive at the fifth and final pillar, the capstone that locks the entire structure into place, understanding the profound asymmetry of opportunity in investing. This is the grand, liberating secret that separates the masters from the amateurs. In most areas of life, you are rewarded for activity and punished for inaction. In baseball, if you stand at the plate and watch 3 perfect strikes go by, you're out. You are forced to swing. The stock market, however, is a game with a beautiful, unique rule. There are no called strikes. You can stand at the plate all day, all year, and watch thousands of pitches go by. You can watch high fastballs of speculative tech stocks, tricky curveballs of complex financial instruments, and low and away sliders of mediocre businesses. You don't have to swing at any of them. There is no penalty for letting them pass. You can simply wait with infinite patience for that one single perfect pitch, a fat pitch in Buffett's words, that comes in slow and juicy right in your sweet spot. And then you swing for the fences. The too-hard pile is the mechanism that enables this strategy. It is the discipline of letting all the bad and mediocre pitches go by, so you can focus all your energy and capital on the rare, no-brainer opportunity. The ultimate anecdote for this fat pitch philosophy is Buffett's investment in American Express during the great salad oil scandal of 1963. It was a crisis that threatened to destroy one of America's most iconic companies. A small, seemingly insignificant company in New Jersey called Allied Crude Vegetable Oil, run by a man named Tino DeAngelis, was a major client of American Express's warehousing division. Allied used Amex's warehouse receipts, which certified that a certain amount of salad oil was being held in their tanks, as collateral for massive loans from Wall Street banks. The problem was, Tino DeAngelis was a con man. The tanks were mostly filled with seawater, with just a thin layer of salad oil on top to fool the inspectors. When the fraud was discovered, Allied went bankrupt, and the banks that had loaned them money were left holding worthless warehouse receipts. The market panicked. The assumption was that American Express, which had certified the receipts, would be on the hook for the massive losses, estimated at over $60 million at the time, a sum that could bankrupt the company. American Express stock was crushed, falling nearly 50% in a matter of weeks. The consensus on Wall Street was that the company was doomed. It was a classic falling knife, an investment that seemed far too risky and uncertain. For Warren Buffett, then a young, relatively unknown money manager, this was not a crisis, it was a potential opportunity. The American Express situation was complex, but he believed it might be knowable. It was not in his too-hard pile. So while others were selling in a panic, he started doing the hard, tedious work of a financial detective. He read the annual reports. He studied the legal situation and realized that Amex's legal liability was far from certain. But his most brilliant move was his on-the-ground scuttlebutt research. He wanted to know if the scandal was affecting the company's core businesses, its travelers' checks and credit cards. Was the brand being permanently damaged? So he started visiting restaurants and banks. He would talk to cashiers and tellers. He'd ask them, "Are people still using American Express travelers' checks? Are you still seeing a lot of people paying with the American Express card?" The answer he got, over and over, was a resounding yes. He saw with his own eyes that the company's customers didn't care about a warehousing scandal in New Jersey. They cared about the trust, prestige, and convenience of the American Express brand. He realized that the company's powerful moat, its brand equity in the minds of its customers, was completely intact. The market was panicking about a temporary, manageable problem, and in doing so, was offering him the chance to buy a phenomenal business at a ludicrously cheap price. This was his fat pitch. This was the opportunity of a lifetime. And because he had been patiently waiting, preserving his capital, he was able to act with incredible force. Buffett invested 40% of his entire partnership's capital into American Express stock. It was a massive, concentrated bet. The investment was a spectacular success, and it was one of the key trades that built his early fortune and reputation. The lesson is profound. The too hard pile is what keeps you from frittering away your capital and attention on 100 mediocre ideas. It allows you to save your resources for that one moment when the market offers you a gift, an asymmetrical bet, where the upside is enormous and the downside, once you've done the real work, is minimal. The psychological biases that prevent us from adopting this patient, opportunistic strategy are subtle but powerful. One is the scarcity heuristic. We tend to place a higher value on things that we perceive as scarce. The financial industry is a master at exploiting this. They present IPOs as scarce, one-time opportunities. They hype certain trends as a once-in-a-generation chance to get rich. This creates a sense of urgency, a feeling that if we don't act now, the opportunity will be gone forever. This is the opposite of Buffett's mindset. He believes that specific opportunities are scarce, but the stream of opportunities over a lifetime is abundant. If you miss one, another will eventually come along. There is no need to rush. There is no penalty for waiting. The too hard pile is a system for enforcing this belief. It trains your brain to see opportunities not as fleeting must-act-now events, but as a continuous parade of pitches. Most will be bad, a few will be mediocre, and very, very rarely one will be perfect. Your job is simply to wait for the perfect one. Another related bias is the endowment effect, the tendency to overvalue something simply because we own it. This is why it's so hard for people to sell a losing stock. The very act of owning it makes it seem more valuable in their minds. Buffett's philosophy of only swinging at fat pitches helps to mitigate this. Because his standards for buying something are so incredibly high, he is less likely to end up owning mediocre businesses in the first place. He is a choosy buyer, which saves him from having to be a forced seller later on. He is not trying to find something to buy every day. He is perfectly content to do nothing for years if necessary. This emotional detachment, this ability to treat opportunities as external events rather than urgent personal necessities, is a hallmark of the master investor. To install this fat pitch mindset into your own operating system, you must embrace Buffett's famous punch card mental model. Imagine, he says, that at the beginning of your investment career, you are given a punch card with only 20 punches on it. Each time you make an investment decision, buying or selling, you have to use up one of your punches. That's it. You get 20 decisions for your entire life. This single thought experiment is a game changer. Step 1 is to internalize the reality of scarcity. Your decisions are a finite, precious resource. You cannot afford to waste them on mediocre ideas. Step 2 is to let this realization dramatically raise your standards. Before making any investment, you must ask yourself, is this idea so good, so overwhelmingly compelling, that I am willing to use one of my 20 precious lifetime punches on it? The effect of this question is immediate and profound. It forces an extreme level of discipline and selectivity. That pretty good idea you had? It's not good enough for a punch. That stock your friend recommended? Not worth a punch. That speculative bet with a small chance of a big payoff? Definitely not worth a punch. You will find that you start saying no to 99.9% of the ideas that cross your desk. You will only say yes when you have found an investment that meets all your criteria. It's a wonderful business, you understand, run by great managers, with a durable moat, and it's available at a price that gives you a huge margin of safety. If there is any doubt, if it feels even slightly like it belongs in the too hard pile, the answer is no. You save your punch. This mindset is the ultimate key to achieving financial independence. It ensures that your portfolio will eventually consist of nothing but a handful of your own absolute best ideas, leading to the kind of concentrated, high-conviction portfolio that generates extraordinary long-term wealth. The antithesis path, taken by the vast majority, is the gotta-be-in-the-game mentality. This investor is terrified of sitting on the sidelines. They see cash as a non-working asset, a sign of indecision. They feel they must be fully invested at all times to capture the market's returns. This pressure to always be in the game forces them to constantly lower their standards. Since true fat pitch opportunities are rare, they are forced to swing at mediocre pitches. They end up buying fair companies at fair prices, a recipe for decidedly average results. Let's call this investor Sam. Sam always feels behind. He sees the market going up and feels like his cash holdings are a drag on his performance, so he buys a stock that he thinks is okay. It's not a great business, but it's not terrible. The price isn't a bargain, but it doesn't seem outrageously expensive. He is swinging just for the sake of swinging. The result is a portfolio cluttered with second-rate ideas that he has no real conviction in. When the market gets shaky, he has no strong analytical foundation to fall back on, so he is easily spooked into selling. He is constantly trading one mediocre idea for another, incurring costs and taxes along the way. Sam is playing the market's game, not his own. He is reacting to its rhythm, rather than imposing his own discipline upon it. He will never hit the home run that builds real wealth because he is too busy trying to hit weak singles just to stay in the game. He fails to realize the most powerful position in investing is not being fully invested. It is being fully prepared, in cash, waiting for the moment of maximum opportunity. His need for action ensures he will be a victim of the market's cycles, rather than a beneficiary of them. The direct financial connection of the fat pitch strategy is the mathematical superiority of concentrated high-conviction investing. It is a direct assault on the conventional wisdom of broad diversification. While diversification is a useful tool to protect against ignorance, if you have done the work and truly understand a handful of businesses, concentration becomes your greatest ally. Let's look at the numbers. An investor who diversifies across 100 stocks has, on average, 1% of their portfolio in each. If one of those stocks doubles, a 100% return, the total portfolio only increases by 1%. It's almost unnoticeable. Now consider the investor who has waited patiently and invested 20% of their portfolio in a single fat pitch opportunity. If that stock doubles, the entire portfolio increases by 20%. This is how real, life-changing wealth is built. The too-hard pile is the indispensable tool that makes this strategy possible. By filtering out 99% of all possible investments, it frees up the mental and financial capital to bet big when the odds are overwhelmingly in your favor. It allows you to align your portfolio directly with your best thinking. This is the ultimate expression of the CEO mindset applied to personal finance. You are not just a collector of stocks. You are a strategic capital allocator, deploying your resources with precision and force into the few opportunities that truly matter. This is the final and most powerful promise of embracing the simple wisdom of I don't know. You have just been given the blueprint for what might be the single most powerful tool in wealth preservation and creation. You now understand that the courage to admit ignorance, to build a fortress around your circle of competence, and to patiently wait for the perfect opportunity is not a passive act, but the ultimate strategic weapon. You've seen how this simple mindset shift protects you from the psychological biases and market manias that shipwreck the average investor, and how it positions you to act with decisive force when a true bargain appears. You have acquired the shield. But this discipline of saying I don't know is only one side of the coin. It's the defense. The other side is the offense, the unwavering, rigorous set of criteria Warren Buffett uses to say yes, with absolute conviction when that perfect pitch finally arrives. Knowing what to avoid is half the battle, but knowing precisely what to look for is what builds empires. The too-hard pile clears the fog, but you still need a map to find the treasure. The video that is now on your screen is that map. It is the next critical piece of this puzzle. It is the link that connects the defensive strategy you've just mastered with the offensive framework that generates generational wealth. It bridges the gap between avoiding mistakes and proactively identifying the handful of truly great businesses that will compound your capital for decades to come. Many will stop here, content with the shield, feeling they have learned enough to be safer. But for those who are serious about building their complete mental arsenal, for those who see this not as entertainment but as essential financial education, the choice is clear. The journey from good to great requires both the shield and the spear. The path to true financial independence is paved with a network of these interconnected mental models. Complete the framework, click and continue your ascent.